Have you ever pondered what precipitated the Great Depression? The year 1929 is etched in our collective memory as a milestone in economic history. The infamous stock market crash of that year sent shockwaves across the globe, influencing the world economy in profound ways and paving the road to the Great Depression. The Roaring Twenties in the United States were a time of unprecedented economic prosperity. The stock market was booming, attracting investors like bees to honey, all convinced that the good times were here to stay. Yet, beneath this veneer of prosperity, ominous signs of an overheated market and unsustainable practices were emerging. Then, on October 29, 1929, the bubble burst. What came to be known as Black Tuesday was a day of panic and a massive sell-off of stocks. The Dow Jones Industrial Average took a nosedive. Fortunes were wiped out at a stroke, and a chain reaction of financial devastation was set in motion. The swift and drastic decline in stock prices left countless investors in ruins. So, what sparked this crash? A cocktail of factors, including rampant overspeculation, the excessive use of credit, and a glaring absence of regulatory oversight. The euphoria over never-ending economic growth inflated a speculative bubble that, when it burst, laid bare the vulnerabilities of the financial system. The aftermath of the 1929 crash was not confined to the United States. The economic downturn spread like wildfire, engulfing Europe and other parts of the world. International trade dwindled, unemployment rates skyrocketed, and economies found themselves grappling to recover from the shock. The crash of 1929 marked the advent of the Great Depression, a period of unrelenting economic hardship that cast a long shadow over the 1930s. Unemployment surged, industrial production fell off a cliff, and individuals faced severe financial hardships. Governments scrambled to stabilize their economies by implementing various policies, but recovery was a slow and challenging process. In the wake of the 1929 market crash, significant changes were made to financial regulations and economic policies. The aim was to prevent a similar catastrophe. Measures like the Securities Act of 1933 and the Glass-Steagall Act of the same year were introduced to increase transparency and regulate banking practices. The market crash of 1929 remains a pivotal moment in economic history. It serves as a stark reminder of the dangers of speculative excess and the critical importance of prudent financial regulation. To fully grasp the complex interplay of factors that led to one of the most significant economic downturns of the 20th century, one must understand the events surrounding Black Tuesday.